Selling is the most misunderstood skill in investing, not because it is technically complex, but because it forces confrontation with emotion in its rawest form. Buying feels hopeful. Holding feels patient. Selling feels final. It transforms paper gains into reality, but it also opens the door to regret comparison and second-guessing. This is why many investors spend years learning how to buy and almost no time learning how to sell, even though selling decisions often have a greater impact on long-term outcomes than entry points ever do. The first hard truth is that there is no such thing as a perfect exit. Markets do not ring a bell at the top. Prices overshoot, reverse, consolidate, and surprise. Anyone waiting to sell at the exact peak is not practicing discipline. They are practicing fantasy. Mastering the art of selling begins with abandoning the idea of perfection and replacing it with the idea of adequacy. A good sale is one that aligns with your plan, protects capital, and supports future opportunities, not one that captures the last dollar of upside. One of the most common reasons investors struggle to take profits is anchoring. Once an asset rises significantly, the mind quickly recalibrates. What once felt like a gain now feels like the new normal. Selling feels like giving something up, rather than realizing success. This psychological shift is subtle and dangerous. It converts profits into entitlement. When the market eventually corrects, the pain is not just financial, it is emotional, because something that felt earned is suddenly taken away. Selling discipline exists to interrupt this process before it becomes destructive. Another obstacle is the fear of missing out on more upside. This fear is amplified by stories of legendary investors who held through massive gains. What these stories omit is context, time horizon, position sizing, diversification, and tolerance for volatility. Holding through large gains is easy to admire in hindsight and extremely difficult to live through in real time. For most investors, especially those managing personal capital rather than institutional mandates, partial profit-taking is not weakness, it is risk management. The purpose of selling is not to predict what happens next. It is to manage what happens to you. This distinction matters. Selling decisions should be rooted in changes to valuation fundamentals, portfolio balance, or personal objectives, not in short-term forecasts. When an asset grows to dominate a portfolio, selling restores balance. When valuation stretches far beyond reasonable expectations, selling reduces exposure to mean reversion. When life circumstances change, selling aligns capital with reality. These are rational reasons. None require guessing tomorrow's price. A critical mistake many investors make is treating selling as a binary event, all in or all out. This framing creates unnecessary pressure. Scaling out of positions over time reduces regret on both sides. If the asset continues to rise, you still participate. If it falls, you have protected part of the gain. This approach acknowledges uncertainty rather than fighting it. Markets reward humility more consistently than conviction. Another underappreciated aspect of selling is opportunity cost. Capital tied up in a fully valued or overextended position is capital that cannot be redeployed elsewhere. Taking profits is not an admission that the asset is bad. It is recognition that the risk-reward profile has changed. Investors who understand this stop asking, "What if it keeps going up?" and start asking, "Is this still the best use of my capital, given my objectives and alternatives?" Taxes and friction also deserve consideration, not as excuses to avoid selling, but as variables to manage intelligently. Ignoring taxes entirely can lead to unnecessary erosion of returns. Letting taxes dictate all decisions can lead to overconcentration and excessive risk. The mature approach balances tax efficiency with risk control, recognizing that paying some tax on realized gains is often the price of preserving long-term compounding. Emotionally selling exposes identity. Gains validate intelligence. Selling removes that validation and replaces it with vulnerability. What if you sell and the price doubles? What if others outperform you? These fears are universal. The investors who master selling are not immune to them. They simply refuse to let them dictate behavior. They measure success by adherence to process, not by comparison to imaginary alternatives. Perhaps the most important reframing is this: selling is not the opposite of investing. It is part of investing. Without a selling discipline, investing becomes accumulation without control. Over time, this leads to portfolios that are fragile, unbalanced, and emotionally exhausting to manage. Taking profits is not about pessimism. It is about sustainability. As markets grow more volatile and narratives shift faster, the need for a clear selling framework becomes more urgent, because knowing that you should take profits at some point is useless without defining when, why, and how that point is reached. And understanding how disciplined selling can protect gains without killing long-term growth is exactly where we need to go next, by examining how to build a selling framework that protects profits without suffocating long-term growth. Because selling works best when it is rule-based rather than reactive. The first rule is to sell when the original reason for owning the investment no longer holds. This is the cleanest and most intellectually honest trigger. If the business fundamentals deteriorate, the competitive advantage erodes, management behavior changes for the worse, or the macro conditions that supported the thesis, reverse holding, becomes hope, not conviction. Selling in this case is not about price, it is about truth. The second rule is valuation-based selling. Even great assets can become poor investments at extreme prices. When expectations stretch far beyond what fundamentals can reasonably deliver future returns, become fragile. Valuation selling does not require predicting a crash. It requires recognizing that upside has been pulled forward and downside risk has expanded. Many disciplined investors sell incrementally as valuation moves from reasonable to expensive to extreme, allowing them to participate while steadily reducing exposure to disappointment. Portfolio-based selling is the third pillar. When a single position grows to dominate the portfolio, risk concentrates quietly. Selling restores balance. This type of selling feels counterintuitive because it targets winners, not losers. Yet concentration risk is rarely noticed until it hurts. Rebalancing gains back into underweighted assets transforms success in one area into resilience across the whole portfolio. This is selling as risk control, not pessimism. Time-based selling also has a role, especially for thematic or cyclical investments. Some opportunities are meant to be rented, not owned. When a thesis depends on a specific phase of a cycle, selling when that phase matures is discipline. Waiting for confirmation often means waiting too long. Time-based rules remove ambiguity by acknowledging that some investments have expiration dates, even if the asset itself does not. Partial selling deserves emphasis. Selling does not have to be absolute. Trimming positions allows profits to be realized while preserving upside participation. This approach reduces emotional load. Regret becomes manageable because no single decision determines the outcome. Partial selling turns uncertainty from an enemy into a companion. It accepts that no one knows how far a trend will go and structures behavior accordingly. The final rule is documenting selling decisions. Writing down why you sold what you expected and what risks you were managing builds self-trust over time. When outcomes differ from expectations, learning replaces regret. Investors who document decisions stop arguing with themselves after the fact. They evaluate process rather than relive alternatives. Mastering selling ultimately changes how investing feels. Gains are no longer fragile gifts that can vanish overnight. They become resources that can be protected, redeployed, and compounded. Selling stops being an act of fear and becomes an act of stewardship. It signals maturity, not doubt. In the end, knowing when to take profits is less about timing markets and more about timing responsibility. Responsibility to capital, to goals, and to future opportunity. Investors who master this art do not exit perfectly, but they exit consistently. And consistency is what allows progress to survive the inevitable swings of markets. If this discussion helped clarify your own selling challenges, consider subscribing to stay with these long-form conversations that emphasize discipline over drama, and leave a comment sharing which selling rule you find hardest to follow. Because recognizing that friction is often the first step toward mastering it.